The following Crypto Academy video is designed to help you understand further how we trade cryptocurrency with leverage. Trading contains substantial risk, especially when you're utilizing a margin account with leverage. By watching this video, you agree to the full terms of this disclaimer and accept responsibility for all of your own trading actions. This lesson will focus on answering the following questions. Before we continue, be sure to read through them, minimize any distractions, and feel welcome to pause the video at any time because there are quite a few helpful visual references for you to see when it comes to understanding the pip calculation. Your lot size determines exactly how much each pip is worth when price moves. And this is a basic concept that is applicable in the foreign exchange market when you're utilizing a leveraged account. Opening a trade requires margin. Margin is a percentage of your account balance which is placed on reserve. This is not a fee, but it is important that you maintain a high enough equity percentage to avoid being margin called for over leveraging your account. Whether you close the trade out in a loss or profit, the allocated margin will go back towards your account balance. Leverage trading is much different than purchasing cryptocurrency on an exchange because when you're utilizing these leveraged accounts, you don't physically own the asset when you're buying and you're not getting rid of anything when you're selling. There are three lot sizes that we will reference. The first is a micro lot, the second is a mini lot, and the third is a standard lot. Now, as we go through some of these examples, you're going to find yourself imagining the possibility of catching 3,000 pips in one movement. If the price of Bitcoin went from 7,000 to 10,000, that would be the equivalent of 3,000 pips. So 3,000 pips on a standard lot is $30,000. 3,000 pips on a mini lot is $3,000. And 3,000 pips on a micro lot, the smallest position size you can take. That's still $300. So put that into perspective when you look at your current account balance, and you can really see how cryptocurrency can help with that growth if you find yourself consistently entering profitable positions. When the spread of Bitcoin says 2,000 before you go to open up your position on the MetaTrader app, that would be like saying the spread of Bitcoin is 20 pips. So expect to enter some drawdown when you first open your position. If you're trading on a standard lot and you open a trade on Bitcoin, you're going to be looking at a $200 drawdown approximately before the price even moves. So make sure that you don't over leverage, but know that there is a lot of potential due to how volatile these markets are. If we look at something like Ethereum, it's calculated a little bit different. If the price were to go from $570.50 all the way up to $600.50, that is the equivalent of 300 pips. And you can expect at times to see the spread say 130, which would be the equivalent of 13 pips. When we go and we look at some of these alt cryptocurrencies, and we see something like sentiment. If the price of sentiment goes from $1.25 to $2.25, that is 100 pips. And we can also look at Omnis Go. If the price were to go from $10 to $20, that would be 1,000 pips. So it's pretty easy to see how these cryptocurrency conversions are fairly simple, yet they're all calculated in a slightly different way. There's not necessarily an element of consistency, so you need to be aware of how that cryptocurrency is calculated so you can properly position. I would really recommend that before you take a live trade, Test with a demo account and see what the conversion is from the spread into how much of a drawdown your account balance is in, and then just do the math so that you can understand easily how the price movement is converted. When we look at some of the other cryptos that are offered for leverage trading, we have Ripple, where the fourth decimal place is the pip. So if we see Ripple go from 60.5 cents up to $1.25, that's about 6,500 pips. There is so much opportunity when you're trading cryptocurrency with leverage, but just remember it does carry that additional layer of risk. In summary, leverage can be beneficial when trading cryptocurrency to multiply your potential profits. Although, make sure you give the market enough room to move. If you over leverage your account, you can take trades in a way where you have a small 5 to 10 pip stop loss, but if price goes against you, you could lose your entire account. You must factor in the spread and know your reward to risk in advance to minimize the emotional response you will experience when trading these volatile markets. And remember, if you were to take one trade and that trade were to go 10 pips against you, that 10 pip movement could be $1, it could be $10, it could be $100, or even more. So make sure that you define a good plan of action when it comes to your trading approach. Be sure to leverage the resources made available to you, and the most important thing is to stay plugged in. As you implement the information, ask questions and remain open minded, because all trading requires is persistence, discipline, and acceptance that you can and will learn this skill set.